adding or dropping products or business segments. Hello all. One of the most important decisions managers make is whether to add or drop a product line or a business segment. This type of decision hinges on the impact it will have on net operating income. The decision criteria focus on the financial loss of contribution margin and the financial benefit from eliminating avoidable costs. Our problem asks that we look at the FGCU bookstore product lines and decide whether dropping the supplies product line will result in either a financial advantage or financial disadvantage for the bookstore. In addition to the financial data presented, the problem states that if the supplies product line is dropped, 25% of the traceable fixed costs will continue unchanged. In other words, 75% will go away. It is also estimated that by dropping supplies, book sales will be affected and decrease by 10%. At first look, it appears that dropping the supplies product line would be a good decision. After all, supplies is unprofitable to the tune of $50,000. A closer look using differential analysis will tell us a different story. To determine how dropping the supplies product line will affect the profitability of the bookstore, management will compare the contribution margin that would be lost to the costs that would be avoided if the product line was to be dropped. The decision rule is to drop the product line only if net income will increase by dropping it. This can only happen if the fixed cost savings exceed the lost contribution margin. Let's first look at the contribution margin. The lost contribution margin equals the lost contribution margin from supplies of $180,000 because that product line is gone, plus the 10% loss in contribution margin for books, or $24,000. Note that the 10% decrease in book sales of $40,000 will also result in a 10% decrease in variable expenses of $16,000 for a net effect of $24,000 in lost contribution margin. It should be noted that at times when a company drops a product line, that the drop may have spillover effects into other departments. That's the case here, as dropping the supplies product line causes book sales to also drop by 10%. The second part of the analysis focuses on avoidable expenses. According to our problem, 25% of the traceable fixed expenses will continue unchanged. That means that 75% of the traceable fixed costs can be avoided. 75% of $200,000 is $150,000. $150,000 of traceable fixed costs will be avoided. None of the common fixed costs are avoidable. Since the lost contribution margin of $204,000 exceeds the avoidable fixed cost of $150,000, we have a financial disadvantage of $54,000. Our decision would be to keep the supplies product line. A comparative income statement may also be used to make this type of decision. A comparative statement will have 3 columns to it: the keep column, the drop column, and then a column labeled the difference. The keep column presents the data as given above, with sales at $1 million, variable expenses at $580,000, the contribution margin at $420,000. Traceable fixed expenses are subtracted from the contribution margin to determine the segment margin of $120,000. Common fixed expenses are then subtracted from the segment margin to arrive at the net operating income of $70,000. This is how things would look if we kept everything the same. The drop column presents the data without the supplies product line. The difference column will present the change between the keep and the drop columns. In the difference column, negative amounts represent an earnings loss, while positive amounts represent an earnings benefit. If we drop the sales product line, sales will total $360,000 instead of $1 million. There's a decrease of $640,000 as supply sales will decrease by $600,000 and book sales decrease by $40,000. Variable expenses will total $144,000, which is down $436,000 as supplies variable expenses decreased by $420,000 and book variable expenses decreased by $16,000. The new contribution margin will be $216,000. This represents a decrease of $204,000 from before. Traceable fixed expenses will total $150,000. $100,000 for books, plus $50,000 for supplies, which are unavoidable. The segment margin now will total $66,000, a decrease of $54,000. Common fixed expenses will remain at $50,000. They cannot be avoided. The net operating income now will total $16,000. So by dropping supplies, we will reduce our net operating income by $54,000. Instead of making $70,000, we will make $16,000. It is important to note that allocating fixed costs to the product lines or business segments distorts the keep or drop decision. Allocating unavoidable common fixed costs in the segmented income statement will always make the product lines or business segments appear to be less profitable than they actually are. An effective analysis requires that we do not allocate common fixed costs to segments and ignore those unavoidable common fixed costs when determining the impact on our bottom line. The total amount for common fixed costs should stand alone as a deduction from the total segment margin to arrive at net operating income. In our case, we would deduct the $50,000 of common fixed expenses from the segment margin of $120,000 to determine the net operating income of $70,000. That's it for add or drop decisions. I hope this example helps. Thanks for watching the video. Good luck.